Hello everyone, welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well during these very strange times. I'm pleased to have with me again Mark Shields, investment manager from Brooks Macdonald, who will be answering a few topical questions. Welcome, Mark.
Hi there, Brian.
Mark, markets have picked up somewhat of late, and I'd just like to run through a few questions that our clients are asking at this moment in time. First one off the bat would be to do with Brexit. What is the likely impact of the Brexit deal on the UK and in particular the UK assets within the portfolio?
Yeah, absolutely. Clearly we saw the end of last year, so 2020, certainly with regards to a lot of UK assets, was dominated by speculation as to what would happen with the Brexit deal, and in the event, it largely panned out as we expected it to, which was a skinny or thin trade deal between the UK and the EU. That had sort of, to a degree, been priced in by markets already. Obviously, in the event, it was positive. It was much better than a no deal scenario. But actually, the reaction was slightly muted, quite simply because it had already largely been priced in. But also, probably more importantly, that the deal made very limited mention or reference to service industries, which obviously within the UK is far more important than the trade and the manufacturing side of things. So whilst we certainly deem it as a positive, and there were some positive movements off the back of it, it was a little bit more muted than maybe some expected. And we do anticipate that there will be further discussions between the UK and the EU in 2021, focused more around the service industries. And that is something, again, that we need to be keeping an eye on. So I'm afraid that Brexit hasn't gone away as of yet. It's still something that we need to keep an eye on, but it is a positive step in the right direction. And in terms of the assets within the Brunsdon portfolios, we've got a few funds in there that did well off the back of the news, specifically UK smaller companies, UK mid-sized companies, and also more cyclically focused funds as well, with those exposure to those companies that have struggled over the past year or so and tend to do better on better news, as it were. So a step in the right direction, but maybe a little bit further to go with regards to that arrangement between the UK and the EU.
Okay, Mark. So work in progress, as they say.
Indeed.
Okay, turning to the US. We've, of course, had some political unrest recently. What are your thoughts on the Georgia Senate elections and the US in general, Mark?
Yeah, obviously very, very topical indeed, given the events that have panned out over the past, well, from when we're talking now, Brian, really the past sort of 24 hours, really. So we've seen a Democrat being elected to the two remaining Senate seats that were available in the Georgia elections, essentially giving the Democrats and Joe Biden control of Congress, Senate, and the White House. So a Democrat clean sweep, which is quite a significant development when it comes to what it will allow Joe Biden to do within the US on a sort of a policy basis. And we've seen on that news, we saw some pretty significant shifts in terms of the assets and the parts of the market that did well. So again, a lot of those cyclical companies, a lot of the financials, a lot of the energy companies, traditional energy companies, but also very importantly, renewable energy companies, all performed very well off the back of this news, whilst tech underperformed. Our take on it is largely that this might be a part of a more of an ongoing shift towards those more cyclical companies and those value biased funds that we do own in our portfolio. Quite a significant development there, and it may be that we see tech start to struggle a little bit on a relative basis, although we still remain pretty confident that technology in general should continue to perform fairly well in the sort of environment that we expect over the next 6 months to a year. So we're definitely not selling out of tech or anything like that, but we just think we need to maintain that balance within our portfolios between those cyclical companies and those higher growth companies, and that's exactly what we have had. And again, it's been a fairly decent start to the year for the Brunsdon portfolios. Much more recent, well, not much more recently, but then again, on the past 24 hours, we saw a lot of political strife, with the Capitol being stormed by Trump supporters. This actually has had a fairly limited impact on the actual economic situation or the political situation within the US. If anything, actually, it's sort of slightly bolstered it, because Trump this morning has basically come out and said that he is now going to support a smooth transition to the new to the new administration, and actually that means that I think he's realised that things gone a sort of slightly a step too far, and he's possibly in some real hot water, and I think he's trying to make some conciliatory gestures. So that should actually be fairly positive as well, I would say. But again, I don't necessarily think this is going to be the first part of a sort of more insipid insurrection within the US. I think the US has generally been shocked by these developments, and actually, we expect this may actually aid a smoother transition of power from here, slightly perversely. So
Okay.
we're fairly positive about that.
Yeah. Okay. Thanks, Mark. Yes, very, very strange indeed. Turning our thoughts to the new year, 2021 and beyond. What are your thoughts, Mark, going forward?
Yeah, really briefly on this one. I think our thoughts really are one of that we expect to see a continuation of the low growth, low inflation environment that we have been seeing, which will benefit those more kind of growth focused companies, such as the tech companies I mentioned earlier on. Will continue to benefit them, but we've got to be aware that those more value positions have come back into focus a little bit again, and that may well be something that we will continue to see panning out from here. I think one of the biggest risks that we're aware of, or we're thinking about in 2021, is certainly an unexpected inflationary spike driven or driving a monetary policy error of some description, i.e. a central bank, a major central bank, raising rates or carrying out some sort of a tapering of some description earlier than the market anticipates. That could well be a potential risk that we are looking at, but we think that's a bit of an outside risk, and actually we remain quite confident in the prospects for risk assets in 2021, certainly in the first 6 months or so. So we anticipate there to be hopefully another decent years for risk assets, following what turned out to be quite a good year in the end of 2020 in terms of performance of those risk assets, which was slightly unexpected earlier on in the year.
Okay. So quite positive outlook. That's good. Okay, Mark. Well, I think that's fine for now. Thank you very much for that input, and thank you very much for watching. As always, if you have any questions, then please be in touch with us. Thank you.